Yeah, I was with the Bank of Japan in the 90s, and it's an institution with 10,000 people and one foreigner. So it is pretty rare to be there. And I think the type of policy they've had in place for a while now, it made sense in the mid 90s, late 90s. At that time, I was working on bank risk issues. I think it's been an inappropriate policy for the last 20 years. Japan hasn't had the same cyclical issues. And when you have zero interest rate, it creates all sorts of distortions and dislocations that I think are very harmful. And the sooner that they can move to a more normal structure and let bond markets, equity markets do their work that they need to do, the better. Ueda Sensei certainly knows this, but he also knows the transition has to be reasonably slow to give households and corporates time to adjust to the new normal when we finally leave. It has really been the zero interest rate policy since more than 20 years ago.
So here's the thing, right? On the surface, at least, officially, it doesn't look like anything has really changed, right? It's just sort of twiddling at the margins, etc. But, unofficially, a lot of people take a look at what they did and go, hey, hold on, this kind of looks like stealth tightening, not explicit, but implicit tightening. What do you think? Is it?
I think when we move to the new normal, there is a signal that longer-term JGB yields are going to be significantly higher, not just 58 basis points, but say 125 to 150 basis points. The dollar yen will be quite a bit lower, say now 140, moving towards 125. But most importantly, for equity investors, the cost of capital is no longer zero. So we're actually going to have some of the important forces in equity markets that are necessary. Where when companies are looking at their return on invested capital relative to WACC, the cost of capital is now meaningful. Companies are looking for shareholder return. What we do with dividends and buybacks, the cost of capital is more meaningful. And if you want to have companies creating value for the medium and longer term, you need the cost of capital to be realistic. And that hasn't been the case for 20 years. So I think this is very important, but it has to occur in baby steps. It can't occur all at once, because I think households and corporates, by and large, aren't really ready for this new world.
Indeed.
Kevin, can investors then who have jumped on this renaissance in Japanese equities live with a potential policy shift by the Bank of Japan and by implication, and you raised this quite pertinently, dollar yen rate at 130 or even 125?
Yeah, certainly the question for investors. So we've had lots of trades over the last 25 years or so where it looked like Japan was doing the things they needed to do, and companies were starting to focus on return on equity, return on invested capital, shareholder return, these sorts of things. And it looked like it was going that way. Equity markets went up, but then it filtered out and didn't have follow through. So right now, there's a lot of signs that things are improving, but I think it is important to be skeptical. I think still hopeful.